Why is private market investing not mainstream? In the private space, you can get something like a fund investing in first position liens that provides a 10% cash distribution on your principal with protected principal. Compare that to the public space, where you can get a bond at maybe 5%, or maybe something like an annuity, where you can get up to 7 or 8% cash distribution on your principal. But in that situation, you usually have to wait at least 5 years to get that high of a cash flow amount. So significant advantages in the private space. And let's take a look at growth accounts. So in the private space, there are a plethora of 20% IRR real estate deals on the market right now. Let's compare that to the public space. If you were to go talk to a financial advisor right now about your retirement, the number they're probably going to use for some sort of index fund is 7%, plus or minus maybe something like 15% standard distribution. So 7% growth. So nearly a 3x return in the private space. So why isn't it mainstream? The answer is that it is, at least for the ultra wealthy, it is. Now, I'm defining ultra wealthy as 30 million in net worth or above. And I got that from one of the articles I posted in the white paper associated with this video. Tony Robbins is publishing a book on this in about 2 weeks, but the portfolio allocation of the ultra wealthy has shifted from 25% to 50% in alternative private assets. Now, that class also invests in stocks and public equities. Many of you, that probably is your growth account, which are stocks or index funds. The ultra wealthy has some of their net worth in there as well, but it's not for growth. What they do is they invest in active funds where they just try not to lose. They know that active fund is not going to beat the S&P, but what they do is they get margin loans against that equity, which gives them tax-free cash to then go invest in higher growth assets like private equity or private real estate. So for the ultra wealthy, it is mainstream. And what you need to understand is we're on the precipice of a wave of democratization of these assets, which started with the Jobs Act that Obama passed in 2012. What that did is it created something called regulation crowdfunding, or Regulation CF, which allows private sponsors to raise up to $5 million with minimal filing requirements. It also expanded Regulation A+, where sponsors can raise up to $75 million. In both of those cases, it provides access to non-accredited investors, where before that, it was extremely challenging for non-accredited investors to invest in private deals. What we've seen since that filing, since the Jobs Act, is an emergence of equity crowdfunding platforms like StartEngine, Realtymogul, CrowdStreet. There are tons of them out there. What we're also seeing are that major institutional players like Blackstone are shifting large amounts of their portfolio from the public space and into the private space. So it is mainstream for the ultra wealthy, and we are on the precipice of democratization, where these quality private assets can now be made available to the retail investor. So now here's my question. Why is it not mainstream for the retail investor? Why everyone that I talk to is thinking about investing in private real estate, but they haven't invested? And here's why. Here's what I found. Most of the platforms or the sponsors out there are still targeting the ultra wealthy. The reason for that is because they're looking for higher amounts of capital raised per transaction cost. So what that means, if they find one person that wants to invest multiple hundreds of thousands of dollars, they gained major cost efficiencies with that relative to, let's say, 10 people who might invest $25,000. So although things like Reg CF and Reg D are out there, most sponsors are still targeting the ultra wealthy. The other thing when it comes to platforms is, although any sponsor, any private equity or private real estate sponsor can list their offering on one of these equity crowdfunding platforms, these platforms charge major fees, up to 30% of the total capital raise. So all of the experienced sponsors that I've talked to that already have investors have no interest in these platforms, even though they could have a greater reach, even though they could reach more non-accredited investors because of the major cost associated with the overhead of these platforms. In short, the private market is something you need to be looking into if you want to grow your net worth in a significant way. And right now, although we have all of these avenues available for that, your best case to get there is to network and ultimately try and find small family firms that are still open to filing a Reg 506B, which allows access to non-accredited investors. If you have comments or questions, I would love to hear them. Or if you want to learn more about how to get connected with these sponsors, please do not hesitate to reach out.